Good morning. I am Disha Needham Barrett, and welcome to yet another in our series of webinars. Today, I am supported by my colleagues who are here, and they are already in the chat and they're ready to help you. So make sure you have your questions ready, and they will be available to help you. Today, we are making good on our promise. As part of our national compliance plan, we are using education as one of our primary tools to ensure that we encourage you in way of voluntary compliance. We're also making sure as an administration that we deliver on our promise of changing the way that we do business by using education to assist you so you can better understand the Jamaican taxation system. So get ready, we are about to begin. Today, we're going to be looking at the annual return of income tax payable. Body corporates are, as you'd know it, companies. And it's also commonly referred to as the IT02. So we are moving straight into our program. Now, we are very deliberate in what we hope to deliver here today. And so we'll be looking at a number of areas. The first of them being the self-assessment system. Then we'll be looking at the legislative and administrative requirement for the filing of the income tax return, and as I said, IT02, a brief overview of the various sections of the IT02. We'll be looking at the mandatory online e-filing requirements. And we'll also be looking at the assistance that as an organization that we provide to you, our valuable taxpayers. And finally, we're going to be examining the benefits of good and proper record keeping. Are you ready? All right, so as I mentioned before, the tax system. Now, Jamaica has a self-assessment tax system which places the responsibility on the taxpayer to declare the results of his business activity to TAG. Now, what does this mean? Now, as an organization, we expect that you are going to be declaring as accurately and honestly as possible. What you'd find is that when you submit your application, we do not immediately police your application, so you're expected to declare your information. Now, you must also be reminded that we do have an audit unit, and it's only at that time you will be required to present documentary evidence to support the information that is on your return. So you are declaring, and for you to declare, you must be able to demonstrate to us information that is relevant to your business. Secondly, taxpayers are required to file returns and pay their taxes at specific times stipulated by the Income Tax Act. Now, as a business owner, and especially if you're a new business owner, you need to be aware of the due dates because there are consequences for late and non-submissions. So that is one of the first things you need to know as a business operator. What are the due dates? What are my obligations? And so once you're aware, that is one of the first things that you are going to be okay with. Then we're going to be looking at where a taxpayer fails to file his return. The Commissioner General reserves the right to raise an estimated assessment. Now, you must be aware that when we raise an assessment, there are certain deductions and credits that are not taken into account. And at that point, you will have to demonstrate to us by way of an objection, in some cases, that, okay, I'm not liable for this. But we don't want you to reach to that stage. We want you to be able to be familiar with the due dates, be familiar with your obligations, and once you are submitted on time, pay your fair share, you are onto great things. All right, so many persons may be wondering, but why do I need to be filing anyway? or I'm just new in business. Why am I required? No, what you must understand is that everything that we do as an administration, we're guided by a legislative framework. We are grounded in our laws. And the primary law that we use is the income tax law. So according to Section 71A of the Income Tax Act, it states persons, and when I use the word person, I'm not referring necessarily to an individual. It is to an individual or a body of persons. So persons in the following categories are required to file tax returns in respect of each year of assessment, whether or not they have income or income tax payable. Let me repeat. Persons in the following categories are required to file income tax returns in respect of each year of assessment, whether or not they have income or income tax payable. But why? By virtue of registration. So you would have registered with the Companies Office of Jamaica, and that would have triggered this obligation. So the first is a body corporate or company, as you may commonly know it, that is incorporated, registered, or constituted under any enactment. A trust or other institution, whether incorporated or not, that is registered as a charitable organization under the Charities Act. And finally, any person, including an individual who carries on or has carried on a trade, profession, vocation, or business, and who is prescribed for the purpose of this section by order of the minister, subject to negative resolution of the House of Representatives. A mouthful, I understand. But pretty much everyone that is in business, once you're earning an income, you are subjected to filing your return, and returns are based by your industry. It depends also on your business structure. So today, our focus are really directly on those that are registered as companies. All right, so we move right along. I hope you have gotten what I've said so far. All right, so we continue. So this return, the IT02, it is used by all body corporates, just as I'd said before, to declare income and the associated tax. So we have different categories. We have insurance companies, we have companies in the special economic zones, or we have charitable organizations. Now the return itself, it has different sections, and it is divided in alphabetical order from A to J. So each section has its own requirement, and we'll be going through the form in a little bit. All right, so you will get an appreciation by then as to how the form is structured. We're saying that the IT02, like all other income tax return, must be filed online. So that there you go with a mandatory online filing. So that's another key thing that you need to know. We no longer accept manual returns. So once it is that you are in business, you are now going to be filing your IT02. And all supporting documents are to be uploaded, because the online filing does provide that access where you're able to upload all the relevant and related documents. And the documents, schedules, and so forth, these are embedded into the return. So it's not that you have to go and pull for a different return. Everything is built into the return. So you will just file accordingly and what is relevant to you. All right. We're looking at filing due dates. Now, the IT02 and all other income tax returns, they are due March 15th of every year. What it means is that we pretty much expect you to be reporting on a calendar year, January to December, what would have taken place in your business. So you have until March 15. Now, we're also mindful that there are those persons who may not operate within a calendar year or begin. But what it means is that you have to apply to us to get what is called permitted accounting period. That means to operate outside of the standard calendar year. Now, we are also mindful that sometimes March 15 falls on a weekend. So what we allow is that you are able to file the first Monday after that weekend without incurring any form of late filing charges. So March 15th, all final income tax return, individuals or body corporates, this is the return. In addition to that return, we have what is called an estimated return. This too is due at the similar timeline. Now, ideally, what happened is that you would have been filing your reporting on your business activity for a year that has ended. So your year of assessment, for example, would have been 2024. Now you're at the beginning of 2025 and you don't know what's going to happen in your business. So what we ask is that you use the information from 2020-24 as a basis for informing you for 2025. Based on the trend of your business, also, you're able to decide if it is that you may be anticipating a significant change, whether in a positive or a negative way. And so the estimated assessment, you're able to, make whatever adjustment that is there. And the form makes provision for all of that. So remember now, IT02 and IT07. The IT07, this is the estimate. IT02, this is the final return. So we want you to know that these returns are there because I remember mentioned before, there are consequences for late and non-submission of returns. All right, so we continue to move along. All right, so I would have mentioned all of the above except the final line. Now, the consequence that I keep mentioning before of late or non-filing, it is at the bottom of their screen. It says late filing attracts a penalty of $5,000 for each month or part thereof that the IT02 is outstanding. All right, you may understand what each month means, but the part thereof, remember I said it's due March 15th. So come March 16th, that's a part of the month. That's the first month that the $5,000 really is applied. So March 16th, if it is that it's not a weekend, in this case, this year it falls on the 17th. So if you don't file by March 18th, that's the first $5,000. Once you're in business and trading, right? Or it says if you want, by virtue of registration, you are required to be filing. So pretty much all filing should be in by March 17th of this year, 2025, for both the final, which is the IT02, and the estimate, which is the IT07. All right, so we are moving right along. What we have done for you today, we have prepared a brief outline of the return in terms of the flow of the return. Now, if you notice here, we have gross income. Now, the return is designed where you're reporting on your income from all sources. As the business operator, we're expecting you to report on income from trade, business, or whatever it is that you're involved in. We're expecting partnership income. We're expecting that if you have a commercial rental, you have a space that you rent, we're expecting that you're reporting on that commercial income. We're also expecting that investments that you have, investment income, yes, that is a source of income. And we're expecting you to be reporting. So what we have here is gross income. And we have used some figures that you're able to follow. So gross income, you look at, okay, what is it that I've earned from? And what I want you to know at this point, do not get intimidated by the return. Yes, it has many sections. You are only responsible to file, to compute and complete the areas that are applicable to you. If you're only in a trade, we're not expecting you to report on commercial income if you don't have any. We're not expecting you to report on anything other than what you are primarily involved in. So do not get intimidated or overwhelmed by the many areas of the return. Just complete the areas that are applicable to you. Now, many persons have the misconception that, okay, I make this money, so I just have to pay taxes on it. No, that is not the principle of taxation. We allow, because we know in order for you to acquire this income or these sources, you would have incurred some expenses. And so we look at the particular industry that you are involved in, and we look at the relevant expenses that are connected. And the law says wholly, meaning it's directly connected. So we're not expecting you to claim an expense that is not connected to the source of income. So that's another thing we want you to be very cautious about. Remember, I mentioned before, everyone who is in business is subjected to an audit. And so in an audit situation, we don't want there to be a situation where expenses you would have claimed are now disallowed, because what it means is that you are now going to have to pay on those. All right. So we'd have to add back the money to the income, chargeable income, and you are now going to be taxed on those that you reported incorrectly on. So we want you to become familiar with your industry. We're also mindful that the pandemic has taught us a whole lot of things. And so there are a lot of creative industries that have emerged. And so we may not necessarily know all the associated expenses there. But once it is that as an administration, we are able to see and justify that, yes, this was a necessary expense. This was a necessary, it was necessary for me to acquire this income. In that instance, then it could become an allowable deduction for you. So we want you to be very mindful. We don't want you to set up yourself for an audit. We want you to be very mindful of your industry, the expenses that are connected to your industry, so that when you are claiming these expenses against your income, then there is no issue. So all deductibles, all exemptions, we want you to be very mindful of them. And then what is happening now, we are going to allow you to deduct those from the income. And what we want to be arriving at is what we call chargeable income. Not chargeable income. What is chargeable income? Now, this is the income on which you will be taxed on, right? But you have to look below and you see that, okay, we have a tax rate and we have a tax payable, but it did not end there. So we are very deliberate at looking at what your chargeable income is before we arrive at any other further deductions. And below you will get some more information. All right. So Jamaica has 2 tax rates for body corporate. Now, this is dependent on the industry that you fall in. We have unregulated entities and we have regulated entities. Now, what is a regulated entities? These are entities that, as the name suggests, they regulate. So we have like the Financial Services Commission, we have Office of Utility Regulation, we have like the Bank of Jamaica. These are regulating entity. And then we have other entities who fall outside, and they are taxed at the rate of 25%. For the purpose of this example, we use unregulated rate, which is a 25%. And so because I would have earned an income from all my sources for $10 million, I have taken out all my deductions. I am now at a chargeable income of $4 million. I have applied my tax rate at 25%. And so I am now liable right here for $1 million. So that is 25% of the $4 million. But then I notice now that there are some credits that are available, and this is where the excitement should really begin. Tax credit. So if you look at from a payable amount of $1 million to a tax due of $450, you may be wondering by now, wow, what could cause me to reach from, less than 50% of what I was initially due for? No, credits. Now, tax credits. What are tax credits? Now, the tax credit is any amount that the government allows you to be written off against your tax that you're due. So we have come up with some creative incentive because we want the economy to be thriving. We want you to be able to have some capital injection back in your business. We want you to be able to employ whoever you want to. We want you to expand and to grow. So what we have done, we have incentivized the whole taxation system for companies so that they are able to claim as credits. And I'm not going to tell you just yet what the two major credits are, because I want you to focus on the structure of the return and just to have an understanding. So as I go a little more into the presentation, we're going to be looking at two of these main credits, because I know you really are anxious to know what these credits are. Now, I mentioned before about the IT07, which is your estimated return. Now, the estimated return means that you would have made this projection and you'd have paid based off your projection. Remember, I said you normally use the year that has been finished as a basis for predicting the year that you are in. So I'd given the example, we're reporting on 2024, and now in the month of February, we're using 2024 information as a basis of estimating 2025. So when the year is finished and you're doing your final, whatever you had paid as an estimate, this is what you are now going to be further reducing. So the credits reduces the tax payable, and you would have deducted the estimate. And then you are at what is now due to be paid. So I know you may be wondering, is it possible to move from $10 million in earnings to $450? Yes, it is. So we want to change the mindset that we are just about collecting money. No, we want to guide you properly so you're able to benefit from your credits. You are fully aware of all your deductibles, all your exemptions. So this is why forums like these, we have made it possible for you to get the necessary information. All right, I do hope that we are all following so far. And just to strengthen the definition that I had before, tax credit is an amount of money a taxpayer is allowed to subtract from taxes owed to the government. Unlike deduction and exemption, which reduces the amount of taxable income, tax credit reduces the amount that is now payable. All right? So what you notice now is that we would, just going back to the slide before, the deductibles came out first, and then we know what was payable, which would have been the $1 million. And right there, the credit now comes into play and further reduce what we are payable for. So the deductibles reduce the income and you arrive at chargeable income. And chargeable income, I want you to become familiar with the tax office language now. We as an administration, sometimes we may use terms you're not familiar with. So we want it to be that if you hear the term chargeable income, you are aware what it is. If you hear about tax credits, you are aware of what it is. So unlike deductions and exemptions, we are saying that it reduces the amount that's payable. So that is where we move from the $1 million, we had the credit of 400,000, and that is how we end up at a payable of 450 after we had taken out the estimated assessment. All right. And we're saying the income tax return allows a non-refundable credit to be utilized first. What a wonderful administration. And why do you think this is so? Because guess what? If it's not non-refundable, it means that you have to claim it within the year that it is applicable. And can you imagine we allow you to claim it so that you don't lose it, right? So we allow you to claim the ones that you can't carry over, and it allows you to benefit to the maximum. Now, we want you to know that all of this is taken in mind because, as I said before, we want to encourage voluntary compliance. At this time, we are going to be taking a little break. Now, after the break, we are going to be looking at the form itself. Now, before we go to a break, which is going to be 10 minutes, we are going to be giving you a little quiz to test, just to, get you. I want to keep the momentum going. So in the meantime, we're going to give you a word. And from that word, we're going to be asking you to find the most words that you can find from this word. Not telling you the word yet. Soon be displayed on your screen. The person who gets the most words, that person will be given a token. Yes. So guess what? In your 10 minutes, while you refresh yourself, just make sure that you are the winner. If not, Disha is going to be the winner. All right? So we're going to be taking a break. And so in 10 minutes, we'll resume and we'll be looking at the IT02. Welcome back. All right. So we want to know, how was the experience where your search a word was concerned? All right. So I am going to be checking to see if I have anyone here that has, oh, we have Denise. And Denise had, wow. Denise is going on. All right. So we're going to be looking at some of these words. We seem to have a winner. Let me scroll down a little bit more and see what's happening with the others. We have Roslyn, and Roslyn is next in lead, going on. Very good, Roslyn. Also, we have Shania. Wow, Shania, you are on a roll. Wow. P. Bailey Green. Wow. Very good. Thank you for participating in our little exercise. We appreciate that. And so we're going to be doing our verification. Remember, we have an audit unit. And so we're going to be auditing those information. And what we're going to be doing, because you registered, we already have your contact details. So the winner will be notified and you will be told where to pick up your token. I really appreciate you taking the time to participate in that. That was very good. All right, so by way of housekeeping, I just want to backtrack a bit. I mentioned before that by virtue of registration or incorporation with the Companies Office of Jamaica, you are liable to file your IT02. Now, at this point, I want to pause to say to you, do not let it be that it's at a time that you really are crunched for time to get a TCC, tax compliance certificate. And of course, the tax language again, TCC. Don't let it be that it's at this point when you approach us that you are told that you have outstanding returns. Remember, from this session, we are saying by virtue of registration that it makes you liable to be filing. And it also states in the act whether you're trading, meaning that you're earning an income or not, you are ought to file. And a lot of persons have the misconception that a filing has to be a whole lot of figures. Your obligation is to file. You are filing based on your own reality. And so if there is no income from trade, there is no income from investment, no income from commercial rental, no form of income. Filing the return is still filing the return. Don't say I don't have anything to put on the return. You have declared, and you have declared that I have no source of income currently. That is good enough for us. And remember again, I stated about the late filing charges. No, $5,000 within the first month. After March 15th has ended, that's the first $5,000. And it continues until the return is filed. Can you imagine going to the nearest office and being told that you have 3-4 years of return? And think of those number of $5,000. It can be very uncomfortable. And then you may have to go through a process of trying to seek a waiver and all of that, while your business is very time constrained, meaning that you really need the TCC at that time. So what we're encouraging you today, ensure that you get the information and apply this knowledge that you have received. All returns must be filed once you are registered as a company. Very, very important for us. All right. So let's get that very clear from now. Be mindful of your filing obligations, being mindful of your due dates, being mindful of your rights, your roles, your obligations, being mindful of the consequences that are associated with late or non-submission, being mindful that the commissioner reserves the right to raise an estimated assessment when you fail to file. And remember, we operate a self-declared system. You are the one who has the autonomy and the responsibility to declare and to declare as accurately as is possible. All right? So just some matter of housekeeping. Finally, remember, I said at the beginning of the presentation that we have a full room. The chat is full of persons ready to take your questions and your query. I don't know if I've been that clear, but I want you to be posting your questions. Even if you're not yet ready, just remember the chat is still available. Post your questions so that they can be answered. We have many, many competent persons who are waiting to take your questions. All right? Okay. So now we're going to be moving into looking at the IT02, which is the income tax return for companies. Some of you may be familiar, some not. So we want to be introducing the form to you. All right, so pretty much, even though this form is manual, what you have to understand when you are online, because I mentioned before that filing is online, we have pulled the form so that you can see for yourselves what it looks like. So when you go online, you will find the form looking pretty much the same as is being shown here. Now, section A, because I'd mentioned before that we have a number of sections, right? So A, B, right up to section J. Section A for us is very, very important. And accuracy of reporting begins right here. We want you to understand that the way you answer these questions, because this section is more of a question and answer or an indication of the applicable answer. We want you to know that the way you answer here will ultimately affect the outcome of the return, right? When you're registered online, and I'll be touching on for those who are not yet registered to file online. Once you are registered online, boxes 1 to 6 are already there. So you wouldn't be completing this area because the online registration allows you, when you go on, you'll already see your name and information relating to your business. So one of the first questions that is there, is this your first time filing? Now, what you have to understand at this point, every law, rule, regulation, everything is embedded into the different returns. So the accuracy begins here. If you say no, the system will tell you the answer is yes, because it's a live system. So if you're selecting that it's your first time filing when you have already submitted 2 returns, it's going to prompt you to say, you probably misinterpret this question, or you need to look back at this question. So you're not able to move past this area until you have answered in according to what exists on your account. The next question is to indicate the period being filed for. I said to you before that the regular filing period is a calendar year, except you have been given special permission to have an accounting period outside of a January to December period. So you are going to be filing. Now, if it is that you operate within the regular calendar year, the period of filing is going to be the 1st of the 1st, 2020, or for example, and the end period is going to be the 31st of the 12th, 2024. That's a full year. So we don't do partial year filing. January to December, from the first day of the year to the last day of the year. So 1st of the 1st, 2024 to 31st of the 12th, 2024. That's your filing period. If you have been given the permitted period, it's the same. So for example, your year begins February. So it would have been the 1st of the 2nd, 2024 to the 31st of the 1st, 2025. All right, still a 12 months period. Have you commenced trading? No. Box 8 or line 8. This is one of the most important questions on the form. Have you commenced trading? No, this particular trading is tied to what we call the loss provision. Now, what is she talking about? No, there's a school of thought that many business do not become profitable until probably the first 2-3 years into business. You're new in business, you're starting up, you're setting up. And so for the first year, you may not experience a profit. You experience a loss. You go into the second year, maybe the loss is not as great, but you still have loss. What this question is saying is that, have you commenced trading? Because the loss provision allows for you, if you are in business for 6 years, within that 6 years, or, and there's an exception, is either or if your gross income is 10 million and less. So what it means is that if you do not fall within these parameters, you are not able to claim the loss against your profit. Because the principle is that, okay, so you made a loss year 1, you made a loss year 2, year 3, you're profitable. Now, we as an administration is expecting that, okay, yes, we are expecting that something is to be paid. However, we're mindful that this particular entity may be new in business. So what we look at, are you within 6 years? So we're giving you a little time to grow. Or are you under $10 million? And so we'll allow you to write off the loss that was accumulated up to this point against the profit. If you fall outside of this, we restrict you to 50%. Yes, man, we forget something. So we want you to understand that this particular question is tied into how you proceed. Within 6 years, all the prior year loss can be claimed against the profit. Outside of the 6 years, or if you are not within that 10 million, under that 10 million bracket, then we want you to be mindful of the treatment. So remember now, box 8, line 8, very, very important. Have you commenced trading? And the question allows you to look, am I within my first 6 years? Am I earning an income above or below the 10 million? And that is where we want you to understand from the get-go the response to this particular question. Now we'll move to line 9. It says that you are to indicate the category that you operate in. I mentioned before at the beginning of the presentation that we have regulated and unregulated. Now, the rates are different. Now, over time, as I mentioned, we know that new and emerging entities have come on the scene. And so we have now 2 other areas. And these are the IPP, which is independent power producers, and we have the trust corporate services provider. So these are new players on the market. Now, you may wonder, but why regulated, unregulated, then we have 2, as if it shouldn't fall in these other 2 categories. What it is saying is that these 2 categories will be allowed to have an applicable tax rate of 25% if for the independent power producer, 75% or at least 75% or more of what you use, your renewable energy source, and we're talking about wind and solar now. Once you use more, that percentage to generate electricity, then we will allow you to use the applicable rate of 25%. If you fall below that, meaning that you're using 20% of your renewable resource to generate electricity, you will have to file at the rate of 33.33%. The other one that I mentioned, the trust and corporate services. Now, these are entities that are set up to manage other company, to form other company, and so forth. They are allowed to use a rate of, the law allows them to use a rate of 25%. Now, box 11. Now, we have evolved as an organization, and prior to being here, we would have gone through a number of revenue measures, and we would have had some that still exist and some that, would have phased out. What we want you to know is that if you operate under any of these prior measures, you cannot benefit from what exists here. It's one or the other. Because, for example, there are those who may enjoy a tax holiday for a particular period. You can't be enjoying that and then you come and be able to enjoy all the available tax credits that is in the current dispensation. You have to choose. So it's one or the other. You can choose to leave, but if you choose to remain, you have to operate according to the provision of that particular dispensation. So we want to make that clear. So if it is that you indicate that you're under any of these incentives act, then the form immediately knows how to treat your return. So I hope I've made myself clear so far. All right, so the first section, section A, is just laying the groundwork for the declaration. So nothing about income at this part, no dollar value, no figures yet, but the answers are very, 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 very important. How you respond determines how the form will, the end of the form, the outcome of the form. So we want you to be mindful of that. So box 8, box 9, right down to box 11, very, 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 very important. And the other boxes may ask about who prepares your return, whether you're doing it within house or outside of your entity. So that's pretty much for section A. Now, section B. Now, remember I said that we look at income from all sources. And as an administration, we have ensured that we try to capture all possible sources. Where we don't have any, we have a box called other, meaning that you put something that you're not seeing. So you can't say, oh, I don't see anything that's relevant to the income that I am earning. There's a box that's called other, and so you are able to place your information there. And your financial records will tell us your industry, your source of income, all your expenses, and so forth. So we're looking at income from trade or business, right? And so box 1 asks us to do that. If you're in trade, naturally you'll be buying and selling and all of that. So you'll have all of this to contend with, all right? And so from boxes 1 right down to box 7 relates to trading and trading related information. Then we look at box 8 that speaks to partnership share. You may have income from another business, all right, from being partnership of another entity. And so we want to know that, okay, Barrett Limited is earning this income from another business. And so we are going to be placing that information here. We're looking at income from rental of property. A lot of time persons have commercial spaces that they rent. Income from commercial rental, we're expecting you to be declaring because that's a source of income. and we allow all expenses associated with rental income, even the property tax, we allow you to be able to claim. So everything relating to repairs and all of that, once it is connected to that particular property and we can verify, not a problem. Those are your claimable expenses. Now we're at the area, and if you notice that it is highlighted, income from investments and other sources. Now, if you notice, gross preference dividend is highlighted. Dividend is mentioned 4 areas of the income tax return, the IT02. Let me repeat. Dividend, in some way or the other, is mentioned 4 places on the IT02. What we want you to pay attention to is what exactly is it asking me about. But what is dividend really? Now, dividend is basically a payout of profit. All right, so you have a company and you see there's a lucrative opportunity to invest in a company. Now, the return that they give to you for the investment when they make a profit, this is called dividend. So you have you have bought shares into this company, right? And so when they're in a profitable position, the payout is called a dividend. Now, dividend can be further classified into 2 types of dividend. So the first one that it says preference dividend, that is there highlighted, gross preference dividend. Now, the other type of dividend, the law says any other dividend other than gross. Sometimes as an organization, eventually we give it a little term. So we commonly just call it ordinary dividend. And a lot of persons know it as ordinary, but just a caution, it's not in the Income Tax Act. That word ordinary is not there. It says any other dividend other than preference. But for the sake of the presentation, if you hear me call it ordinary dividend, just know I'm not referring to preference because the treatment is different. Now, the first dividend it asks you, it says gross preference dividend. Now, dividend, in terms of preference and ordinary, they have 2 different rates. And so that is why you have to pay key attention if it says preference or it says other than preference. Did it say gross preference dividend or gross dividends other than preference dividend? So we want to be paying attention to what it is that is being asked right here as it relates to the area relating to investment. Okay? Now, dividend, gross dividend, these are usually persons who the value of the investment is usually greater and it's riskier, and there's usually a guaranteed payout. So it acts similar to like an interest from the bank. So interest at the bank is paid periodically at an agreed amount, agreed rate. The gross preference dividend operates similar to that. What it means is that you will be paid, and the rate for this is 25%. All right. Now, we want you to understand that the next slide, the next highlighted area, it says gross dividend other than preference dividend from companies resident in Jamaica. And in bracket, it says franked income. Now, this is the area that we want you to understand, because right here is another terminology that we want you to be familiar with: franked and unfranked dividend. So we have gross preference dividend, and we have dividend other than gross preference dividend, which is also referred to as ordinary dividend. From there, we are now saying that dividend can either be franked or unfranked. But what is the difference really? All right. So once it is that as a company, you have invested with another company because there's a lucrative opportunity to invest. What it means is that when you get this dividend, right? The dividend that is paid to you, you will get a certificate which shows that this is a payout and this is the portion that is withheld. So in terms of reporting, you will be able to report the gross dividend, and then you're going to be able to report the portion withheld, so that in arriving at what is payable, then there is a clear distinction. So that is for the unfranked income. So I have invested in company A, I get this payout, they give me the certificate to say, here it is, that your return is $1 million, right? So this is your dividend. And I have withheld whether the 25% or the 15%, depending on if it's preference or ordinary. And when it is now that you have seen this, you are going to be reporting accordingly. So you need to make sure you are not placing your franked income into your unfranked area, or the box for the unfranked into the franked. So understand the distinction. So unfranked meaning that I have invested in company A, this is what I got, they gave me the certificate, they told me I got $1 million, and they were told 15%, which would be 150, or 25%, which is 250. And so on my report, I'm able to place those at the income side and at the credit side. All right. Now, the franked income, there must be at least 3 players. So I invest with company A. Company A invests with company B. Now, remember, no, I did not invest with company B, I invested with company A. When company A pays me that dividend, it is with the expectation that that company has already suffered the tax on it. So in my hand, being the recipient, filing my IT02, I am going to be putting that information at the area that says gross dividend. If it is the other dividend, I'm going to be putting it at gross dividend, that's line 13, gross dividends other than preferred dividend from companies resident in Jamaica, franked income. All right. So we want you to know that do not put the information in 12 when it should be in 13, or put it in 30 when it should be 12. So you have to have an understanding of your investment. All right. Because guess what? If you put that information that is a franked or unfranked in the incorrect box. So for example, you put it in the franked area, box 13. You are not going to be able to input the credit information. You are not going to, you may be wondering, but why is it that I can't have my credit? So it means that I'm going to pay more taxes. You must go back to the beginning of the form at section B to look to see which box did you put it in. So unless it is unfranked, you are not able to put the credit, because remember now, it is assumed that the company that you invest with, who invest with another company, would have already suffered the tax. I do hope I'm making myself clear. And once again, let me pause to say, use up your chat. At the end of the session, we'll be trying to take some questions, but I just want especially here for you to get the dividend provision. All right, so we look at interest. And we know interest is normally, you know, what you get, your return on your investment at financial institutions and so forth. And so we have all these things relating to investment, and investment within Jamaica and investment outside of Jamaica. But we want you to get the dividend provision. Here again, you see dividend being highlighted, gross dividend, right? So the treatment of dividend outside of Jamaica is determined by the existing double taxation treaty. While we have full autonomy and management of dividend earned within Jamaica, the treatment of dividend earned outside is determined by what exists with the country within which you actually invest in. So you invest in a country that falls within this treaty agreement. So whatever provision is there in terms of the treatment and the rates, that is what we use. And we're also saying that where the recipient has substantial holdings, meaning that you have 25% or more voting rights in another company, your dividend is taxed at the rate of 0. Let me repeat. Where the recipient has substantial holdings, which is equivalent to exceeding 25% of the voting rights, the rate of tax is 0. Otherwise, the rate of tax is 15% as it relates to the ordinary dividend. Now, we have to understand also that with ordinary dividends, the shareholders, they have voting rights. Preference, they don't necessarily have that. So there's also a treatment to that. All right, so we go down to line 26. And of course, gross dividend that we call ordinary, other than preference dividend, unfranked from company resident in Jamaica, and it tells us where to transfer it. So remember, one line speaks to franked and the other to unfranked. Unfranked, meaning that I invest with a company, and once I'm getting a dividend from their profit, I am going to get a certificate. The certificate will show the amount that was paid to me and the tax withheld portion, because by law, these entities are mandated to withhold and to report. But for your reporting purpose, they would have given you the certificate so you can get it as a credit to reduce what you're liable for. With franked dividend, it means that you have invested with company A who was invested with company B. So you being the third person in that scenario, it is considered that whoever you invest with would have suffered the tax already. So that percentage is already deducted. So you are not going to be doing anything different. However, this is an income tax return. So all sources must be declared. And what you will find is that some things will appear on the return because they are tied to the return. So you are declaring, and of course, here, because it's already accounted for, you don't need to go to the area related to credit where the franked income is concerned. I do hope I have made some form of sense where that is concerned. So remember now, 4 areas on the form relating to dividend. You have referring to gross dividend. You're referring to gross other than preference. You have gross dividend that is franked and gross dividend that's on whatever it is. The dividend is either franked or unfranked, and it's either preference or other than preference. You have to pay attention. So what happened is that over time, because we have become familiar with common mistakes, when someone may say to us, I am not able to put my dividend, the amount that is withheld for my dividend, it's not allowing me to. What we can immediately pick up is that, okay, you report it in the incorrect box. So we don't want you to, especially for persons who are down to the wire. It is March 14th, and you are calling, and because everybody else is calling, you can't get that information, and you are flustered and frustrated and don't know what to do. So we want you to understand that the correct boxes determines the outcome of your return. Gross dividend, dividends other than preference dividend, dividends other than preference dividend, franked income, franked dividend, unfranked. Franked meaning at least 3 companies must be involved, or 3 players must be involved. Unfranked, 2. If you put that in your mind, then you will get the understanding. So if you are not in that, just look for the unfranked, meaning that it's just a one company who pay me something as a shareholder. All right. So they probably raise and put something out there. They need to do some capital injection. And they said, okay, we're offering some shares because we want to expand. And I have gotten in on this opportunity. And so when they make the profit, they pay me. That is my unfranked dividend. All right. Hope I am clear. All right, so we'll be moving on a little bit. Remember, keep those questions in the chat. Keep your questions coming in the chat. We want to be able to ensure that you get your answers in. All right, so I would have mentioned before, when we look at the structure of the return, the gross income, the deductions, the exemption, then we arrive at our chargeable income. All right. Now, before we reach there, now let us go back now to 2 provisions that are in law. So these are the first deduction that you have, and these are allowable deductions. So expense, yes, these are mandatory things that I incur to get this income. Deductions, allow the deductions. It means that, okay, for my business, I had to make some capital purchases. I bought some items that I need in order to operate my business. And what we want to also understand that it can be intangible asset as well, like intellectual property. But for the purpose of this, let me just use a physical asset. What the provision for capital allowance allows is for the value of the asset to be written down over a period of time. Technically, you're getting an opportunity to get back the value of the item that you bought. So the capital allowance, and there are 2 regimes. We had one right up to 2014, then we changed. I don't think anybody will be filing at this point because remember, we have a restriction as to how long we expect a return. So pretty much everybody is within the new dispensation. And so the capital allowance schedule, it gives a list and a breakdown of every type of capital item, tangible and intangible. It gives the rates. It tells if there's an initial or an annual provision and how it is that you treat it. And so the schedule is built in the return again. And if you don't see the schedule, it is there for you can pull it down from the form section of online and you complete it. What it asks for is the date of the purchase, the type of purchase, the value of purchase, and of course, as an organization, if you purchase that item 1 month before the year end, we have to prorate it. We can't give you the full amount if it is that you just got this item. So, you did not use a full year. So some prorating provision will have to be in place. But it is very easy to follow because you don't have to guess what's the rate. You don't have to guess if there's an initial or annual. Some will have both, some will only have one. You don't have to guess what the item is. So you're able to follow and to apply so that you are able to report correctly. Now, remember, your income is going to be reduced. Whatever you're going to be taxed on, whatever you're going to ultimately pay is going to be reduced. So imagine you not keeping a record of this item that you bought and you miss this capital allowance provision that would have reduced what you are liable to pay. And so if you probably remember a little bit on this slide, one of the deliverables for today is looking at proper record keeping. Now, once it is that you are able to, we want to be able to say, okay, I have utilized in this first year, this is what I've utilized. So I have a written down value to take forward to 2025 when I'm filing by March 15th of 2026. I will now be able to further until it is written off to zero. All right. We also look at what is called donations. And if you notice, and I want you to zoom in onto the highlighted areas, because these are some of the areas where some of the common misunderstanding, misconception, these are where they usually fall. So that's why we're careful as to highlight the specific areas we want you to really understand. Now, we have covenanted donations. Now, Jamaicans, we are known for a spirit of generosity. Hands down, we are a generous people. We are our neighbor's keeper, and we love to see, needs and to respond accordingly. However, as it relates to tax and taxation, there are certain principles that are there. So we don't have a problem with you being generous. And we, as an administration, we are not saying to you, do this, don't do that in terms of how you give. However, there are guides in law as to how we treat donations. Covenanted donation. Now, as the word covenant suggests, for those who are of the faith, when we look at what a covenant is, it is usually a binding agreement. And if you know the Bible, for example, when there's a breach of covenant, there is usually a consequence. All right? Now, the covenanted donation acts in a similar way. Now, covenant donation, this is an agreement that is either with the University of the West Indies or the University of Technology, UTech, or any other ministry that the government allows. And so you enter into a binding agreement to provide these donations within for 5 years. Not 1, not 2, not 4, 5 years. So the covenant relationship is for 5 years. Every 5 years at whatever agreed amount, agreed timeline, that is between you and the institution. But these donations are going to be given 5 years. Now, what we want you to understand, if it is that you are, as an organization, as a company, have entered this agreement, right? You're allowed to the value of that donation is reduced against your chargeable income. So you are not going to be taxed on that, the value of that you have donated. However, I must caution you, we know things can happen. However, regardless of what happens, if it is that there's a breach within the 5 years, you have to pay back those. Pay back in the sense that it's not going to be added back to your chargeable income, and you have to report the tax on those. So that's what we want you to understand where the covenanted donations are concerned. Usually with these established institutions, UTech and any other that the government allows, and the relationship is for 5 years, and these are donations that are made at periodic timelines, at whatever the agreement is, every year, and the company is allowed to reduce or write off these donations against their chargeable income. All right? Now, we have other donations. No, the spirit of generosity is high. So I'm not giving to these established university. I have a community need, or my children's school, or whatever it is. If it is that the donation is not to a charitable organization, and remember now, a lot of persons will just set up something and say it's a charitable organization. A registered, active charitable organization. The law is very specific, to the point where there's a listing posted every year of the active charitable organization that are operating in Jamaica. When you go on and do your search, you can find these registered charities. So giving to your school or your community and so forth, not a problem. But for the purpose of income tax, those cannot be written off against your chargeable income unless they are given or donated to a registered charitable organization. Again, I say, if you don't know who are registered or not, there's a listing that is posted annually, and it gives the status of these charitable organizations. So we're not stopping you from donating, but for the purpose, because remember, the less chargeable income you have, the less taxable payable. All right? So we have to be mindful that we are an authority. And let me pause to remind you what your taxes does. Taxes contribute to national development. Taxes is used for education system. It is used for the health system. It is used for the infrastructure of the country. It is used for national security, and it is used for social services. So we have to be mindful that we need the taxes in order to keep the country afloat. So while there are provisions in law, as I mentioned about the tax credit, we have to be mindful that, you know, for the purpose of taxation, that some deduction that you may choose to give, or some donations, we can't just write it off and then you just pay whatever. No. Everything that we do, as I said before, we are guided in law. All right? So remember now, the covenant, an agreement, 5 years, the institutions that I mentioned or any other that the government decides, 5 years, you breach the agreement, just like in the Bible, what happens when there's a breach? Similar in the breach, we are expecting you, we are going to be doing what we call a clawback. We need back that money. All right? You have to report it, and you'll be taxed on that amount that you would have gotten, but did not fulfill the 5 years agreement. I hope the chat is buzzing. I do hope the chat is buzzing. All right. I can't see the chat right now, but I believe, I am confident that the chat is buzzing. All right. Now, remember the section of the form that I told you about that asked about the loss? Have you been trading for the past 6 years, or have you commenced trading? Sorry. I think it was question 8 of section A. Have you commenced trading? And I made mention of the loss provision. All right. So section E, this is where, you know, that question is tied into this area of the return. And if you notice, it asks for losses brought forward from previous year. It asks for current loss. And then it looks at the total available loss. So the loss from the 2 years in business. And then now we're looking at this year of return, 2024. What is our loss? All right. And I want to pause to let you know that we are going live on YouTube. So anyone who is not yet on, tell your friend, tell your neighbor, tell every other business associate, we are going live on YouTube. Right. So the allowable loss now, back to the question that I mentioned. It says, is trade or business within the first 6 years of operation, or is gross sales less than $10 million? So right there, you have an appreciation of question 8, because guess what? I am now in my 2nd year, and the first and second year, first year never so hot. I made a loss. I am now able to claim all the loss brought forward this year. If I'm still in a loss and it's accumulated, or if I'm profitable, I'm able to, you know, as I'd mentioned before, it's for loss provision. All right, so we continue. All right, so we're looking now at the tax computation. Remember, I mentioned in section B about the importance of questions 12, 13, and so forth relating to the dividend. All right. So what we're looking at now, it says gross dividend other than preference dividend unfranked. Now, this is where I had said to you If you had put in box 13, which is a franked dividend, and expecting to get your credit here, you're going to see that you're not able to, because you are reporting franked income and coming to claim as a credit right here for franked, unfranked. So that is why we're saying pay key attention. If it was unfranked, meaning you select the correct box, you're able to put your credit right here. Sorry, the dividend right here, right? So we want you to understand that those boxes are important. So you're going to carry forward now the gross dividend other than preference, which we call ordinary, is going to come right at line 1. And at this point, it's going to be doing a deduction. It says at line 2, transfer from section D, line 7, and we have that information. Now, if you notice boxes 3, it looks at the tax on chargeable income. So now we have done all the sifting out. We have taken out the expenses, we have taken out the capital allowance and so forth. Now we are going to be looking at what it is that I am now liable for, right? And if you remember the example that I gave, we had the $10 million, then we had some figures going down. So pretty much what it is looking at now is always that this $10 million is going to be, shared based on whether my investment, I had investment income. So if I have investment income, if you go down to line 7, you're going to notice that it separates it. Why? The rate is different. We have 15% there because it says tax payable on dividends other than. So while we may be taxed at 25% or 33.33%, depending on if we are regulated or unregulated, at lines 3, we are now going to be looking at 7, where it says what it is that I am reporting here. And I'm going to put it there so that I am not taxed at 25 or 33.33. I am taxed at 15%. I also mentioned before that if a company has more than 25% voting rights in another and gets dividend, then the rate is 0. So if you look at box 5, and 0 is a percent, it's just that it's not going to realize into a material figure, but 0 is still a percent. All right. So what it has done here is to break down the different tax rates based on the chargeable income, because what we're arriving at box 9 is what it is that up to this point I am liable to pay. All right. So I have declared my income from all sources, and now I probably have trade income, I have commercial income, and I have dividend income. The treatment from lines 1 to 8 determines what happens at line 9. So 3, applicable rate, 25% or 33%, 33.33%, depending on if I'm regulated or unregulated. Box 5, if I have more than 25% voting rights, then I place the value of that dividend here, but it's taxed at 0. So technically, I won't have a figure there. Then thirdly, we're looking at the ordinary dividend, and that is taxed at a rate of 15%, not 25, not 33.33, not 0. And then I arrive at what I am liable for. But that's not where it ends. Yes, I am liable for the $1 million based on the example I gave before. But look at what is happening now. The beautiful word of tax credit coming back. And I'm sure that is what we want to hear about, the tax credit. How can I pay less from that $1 million that I am now liable to pay? Now, we have lines 10 to line 16, and there are a number of things going down that can further reduce what you are liable to pay. For the purpose of what I know you really want to hear, we're going to be looking at 2 of them. We're going to be looking at the corporate tax credit and the employment tax credit. Now, these are two lovely golden eggs that the administration has been given. These came about, the corporate tax credit came about, I think about as early as 2020, and the employment was a little earlier. But different revenue measures would have brought about these lovely baskets of goodies. Now, the corporate tax credit, what is that? Now, the corporate tax credit, this is a credit that is available only to companies. No other industry gets it. Individuals don't get it, partnership don't get it, companies. And what it means that you are able to claim as a credit up to a maximum of $375,000. Can you imagine? Imagine having $1 million right there, 375 shave off. So you are now left with the balance. However, what I want persons to understand, you must have an income tax payable. So if you are in a loss, there's no way you need a 375 because you're already in a loss. So we can't write it off against a loss or a negative figure. If you are payable for 200,000, we can't give you 375. You only owe 200. So therefore, it's up to the maximum of what you owe. If you owe above the 375, then we give you that. So we don't want persons to say, but the government says it's 375. But remember, you're only liable to pay the government 200. So it is up to what you owe. This is one of the credit that we can't carry forward. You have to utilize it in the year of assessment, the year you're filing for. All right. And remember, I had said we made sure put it in the non-refundable part first. So the administration, nice. We make sure you're able to claim your maximum because you can't be refunded and you can't carry it over. So we want you to use it. So you'll find that you move from payable to zero. No, I don't know if you are really understanding. I'm liable for 300,000. And by virtue of this provision, and remember I said that a lot of the laws, all of the laws, rules, regulations are built into the return. You do not have to put in this 375. It's already there. So your corporate tax credit is already on your account. And that's why the online is mandatory. Once you have the tax liability, immediately the corporate tax credit is looking to say, okay, how much am I giving company A? So if you are 300,000, they said, okay, I only need to give you 300,000 out of the 375. And so right there, you are at a payable of zero. If you're 500,000, they said, okay, I can give you the maximum. You just have 125,000 left. Right there, you only have a tax liability of 125,000 after this particular credit is applied. Doesn't get any better than that, but yes, it does. The next one below, employment tax credit. Now, I want you to understand that I mentioned before, and I'm going to say it again. One of the first things to do as a business operator, new or otherwise, and when we say new for us is up to 3 years. We need you to be familiar with your rights and your obligations. Your obligations are determined by what is happening now. Do I have employees? It means, therefore, my obligation is to have a payroll. Am I in an industry that requires me to be registered for GCT, General Consumption Tax? Am I in an industry that is exempt from it? So you must be familiar with your obligations. And we do have, especially my unit, which is responsible for education, where we provide advisory for new and existing business regarding their rights and their obligations. Now, back to the employment tax credit. So you have employees. This particular credit or this particular benefit is in place for employees who, one, you must have a payroll. As the name suggests, employment. So you must be an employer, must have persons, you must have employees. Employment tax credit. So you must have a tax liability. What we look at now is what we call specified payments. What are specified payments? So your payroll have what we call taxes and contributions. And at this time, let me make it very clear. There is a difference between taxes and contributions. Taxes is what we use, as I mentioned before, for national development. The national security, the health sector, the education system, that's national development. That's what the taxes are used for. So the payroll, taxes, and contribution. Contributions benefit the contributor. So the contributions that we are familiar with, the National Insurance Scheme and the National Housing Trust. Now, these are your contributions, and they benefit your individual employees. Contributions, contributor. Taxes, national development. So we're looking at your payroll, your statutory payroll. We're looking at your NIS, or National Insurance Scheme, your National Housing Trust, NHT. We're looking at your education tax, ed tax as we call it. And we're looking at HART. The only one that we're not going to be including is the PAYE. PAYE is borne on the individual only. All others, except for HART also, there is an agreement where the employee pays a particular rate and the employer matches it. No, these rates are already prescribed, rates are set, and they are all there. Now we're looking at your payroll. We're taking out the PAYE. So we're looking at the total, what we call specified payments. We're looking at the fact there are 12 months in the year, right? And even though I may not have mentioned the due dates for the payroll, they are what we call the employer's monthly return, or SO1, another S01, sorry, another term that you need to be familiar with. So S01 is due by the 14th of every month. So what you're doing is reporting what has happened the month before. We're in February, sorry. So for January 1st to 31st, we're expecting that your payroll information is to be reported by the 14th. Now, when we're doing the ETC computation, we're looking to see, were you on time and paid and filed on time for all 12 months, 10 months, 2 months, 1 month, no month at all. We are going to be looking at the months that you were on time in terms of your filing and payment, not just the filing and payment. Then we're going to be looking at 30% of what you're paid for. So you would have had the $1 million, your CPTC, take out the 375, and you're at 625. So we're looking at, okay, what is 30% of that? Then we're going to be looking at the total value of these specified payments that we were early for in terms of filing and payment. And then whichever is lower, that's what we're going to be allowing as your employment tax credit. So that's a further deduction for you right there. So you are moving from $1 million payable to having a benefit of an automatic corporate tax credit. And now you may possibly benefit from employment tax credit. Now, I also want you to understand, as new business operators or even the existing ones, of how your filing impacts your employee. Think about it. Now, Disha has heard from our colleagues that, well, there's a new housing unit and you're excited because you're saying, okay, based off my pay, they say I must be earning above minimum wage. And I look at my pay, I look like I'm above it. And I look at my pay advice, and right up to February, I'm seeing where all my deductions are there. So yes, I'm up to date. So of course, remember the contribution benefits the contributor. So I am a contributor, I am seeing NHT coming out. So I go nicely to NHT, sit and wait, and they escort me to the officer. And I'm here to check out the benefit because it told that my coworker told me that there's a timeline for submission of the application. They're going to be closing off, and I want to benefit. I look and I said, okay, myself and my husband, when I look at this, it's $15 million. Yes, the housing is 12. So we are clear. The officer looks at it. The officer asks me for my TRN, asks me for my NIS. The officer goes on the computer. Probably I see the expression on the officer's face. And of course, not paying any mind because I am up to date from February 2025. Officer Mrs. Barrett, we're not seeing any contribution for you from January 2023. Let me leave it right there. So you have to understand that it's a win-win for everyone when you file and pay on time. You're benefiting on the one hand from the employment tax credit, and your employees are able to benefit. The NIS, remember, though it is a contribution to a scheme, many persons may not reach the age of retirement. Life is happening, and things can happen where there are loss or dismemberment. It can be that a contributor dies, leaving children under 18, leaving their spouse. And so the contributions from the NIS, it benefits current contributors as well. So we want you to get into the understanding of how your contributions, your filing and paying on time, how it impacts your employees, whether in a positive way or in a negative way. All right? That's what we want you to understand. And so we want you to, just a reminder, keep the chat buzzing, keep the chat going. Send your questions, send your queries, any concern you have, anything you're not clear on, we want you to post them so that we are able to answer them. And so we want you to know that also this benefit is available to all industries in terms of your filing. Even if you're even for sole proprietor, once they have the payroll, once they're not under an existing other arrangement that I mentioned at lines 11 before, 10 and 11, under another incentive scheme, they are able to benefit, all right, with a few exceptions. I'm not going to go into the exceptions right now because we know who our audience are today. And we're saying we want to incentivize our micro, small, and medium enterprise. We want you to be able to grow. We want you to invest and reinvest. We want you to be able to hire more persons, to expand in whatever way you want, because we want a thriving country. And so taxes are what are used to ensure that the country is operating at the level that we really want to. All right. So now I am I'm still arriving at what I am to pay. So I am now moving from line 9 for what I was liable to pay initially. I am now looking at lines 13, where I have got my corporate tax credit. I am looking at line 14. I have now gotten my employment tax credit. And I am now looking at 17, where I'm tallying the total further reduction to what I'm liable for at 17. And what I have now, tax on chargeable income less non-refundable tax credit. So I am now separating line 7 from 9. So on the one hand, I was liable here for the $1 million. I now have at 13 corporate tax credit at $375. And whatever my employment tax credit is, I put that at 14, tally the 375 plus that, put it at 17, and at line 18, I am now at a new payable amount. All right. So now we're looking at refundable credits, and there are some of them that are here, right? I am also looking at the amount that I would have, you know, in terms of if it is that I have made an investment with a financial institution, or I had gotten dividends. Remember, I mentioned about the certificates. This is where now I'm going to further reduce, because remember, I would have suffered the taxes already. The financial institution would have withheld the interest portion, because the law says you pay out X as gross interest from the financial institution, you withhold the 25%. So when I have my interest certificate, I am now able to place it here to say, okay, I have suffered the tax here, so I am going to be further reduced. Similarly, with my unfranked dividend, I am now able to use my certificate, and I am going to be placing at 21, whatever it is that it is. And now I'm going to be going further, looking at all of these, and I'm going to be arriving at my net taxable line 27. But remember now, I mentioned the IT07. Did I pay any money in for my estimate? Because remember, if we're filing now, it means that March 15, 2024, I would have made an estimate for 2023, and I would have filed a final IT02 for 2023. So did I make any estimated payments in the year 2024? Now that the year has ended, I know I'm going to be able to separate the value of that payment that I have made or prepaid, and then I'm going to be arriving at my balance. And if I had paid, I am further reduced. So I am moving from total income, all the allowable deductions, all my exemptions, and I'm at chargeable income. Then from chargeable income, I'm looking to any tax credit that's available. And I mentioned two of the ones that we are most familiar with, the corporate tax credit and the employment tax credit. I am reduced further by what I'm liable to pay. Then I'm looking at, did I make an estimated payment? I'm separating those. I'm looking at, did I get any, by virtue of my investment at a financial institution or within a company, did I get dividend payment and the portion that was deducted from my unfranked dividend or my gross interest? Did they with the portion that they withheld? I now have my certificate and I'm able to apply, and I am now at the balance payable at line 29. And this is where I could be moving from a payable amount of $1 million to zero, to negative, to whatever it is, because I would have applied all that I'm able to reduce my tax liability by. And this is where I am at line 29. All right. So outside of that, let me just go back here before I go to just the other part that requires information about your directors or your principal officers. Just remember now the flow, just learn to appreciate the flow. We're looking at total income from all sources, resident in Jamaica and overseas, investment income, commercial income from commercial rental. We're looking at partnership income. We're looking at income from trade and business. Then we're looking at what was my expenses? What did I buy that I needed to use? Did I buy probably this desk that I'm sitting around because I need it in order to function in an office space? So I'm looking at the capital allowance provision that is there in law. So I'm now looking at further, what are my tax credits, right? What are my tax credits? I'm looking at automatically I qualify for the corporate tax credit. Then I'm looking at how vigilant was I with my payroll, or was I with my filing? Was I on time? 12 months, 1 month, 3 months, and I'm able to get that provision. Then I'm looking at now the interest certificate that I have from the financial institution. This was the gross interest. They took this amount, they withheld it, and they paid me this. for the purpose of reporting, I now have to put that amount there. My income that I got from investment in one company, my unfranked income, and they have given me the certificate to say I've withhold this 15%, I am now able to place it here, and I'm arriving at what I am liable to the government of Jamaica for, right? Because we need the taxes for national development. And pretty much that is the form in a nutshell. We just know that outside of that, G looks at, the principal benefits of the members, and the information is clear. The TRN, the name of the member, the distribution of the shares received, directors, numeration, and so forth. We have salaried director, we have director that are not in the day-to-day operation. You will know how to treat this. Section H asks about connected persons, and you are to declare. Again, we are expected to be honest with this declaration. Where you are affiliated with another company or connected company, you are to answer correctly here. And we have just basically the information relating, but for the purpose of the online return, this area relating to the preparation, who prepared the return, this is at the beginning of the return when you are online. For the purpose of the manual form, you'll see that it's at the back. But just be reminded that when you are filing, this particular area is under the question and answer section, section A. Before you go to section B, it will ask information related to your preparer, address, TRN, and the contact number. All right, so pretty much this is it. The declaration is online. You click. We always have a declaration because we are asking you, did you report correctly and accurately to the best of your knowledge? Once you have indicated, you are now able to make your attachments and submit. All right. So that's it for us where it comes on to the IT02. All right. So we are now going to be taking another 2 minutes break. And what we'll be looking at, we're going to be looking at the online filing requirements, especially for those persons who have not yet registered to file online. I would have spoken repeatedly about it. So maybe there are those who are on today, who are not yet registered. We want to take you through that process so you are able to get in on the action. All right. So 2 minutes break and we will resume in a short while.
FlexJobs is the #1 job.
Welcome, welcome, welcome back. And it is with great pleasure that I announce that we have a winner. We have Miss Kamisha Gordon Green. She is the winner of today's exercise.
Congratulations and celebration when I tell
Congratulations, Mrs. Gordon Green. We are happy that you took the time to participate. All right, so we do have your contacts. So we are going to make sure that you get your token as promised. All right, so thank you again. And for all others who participated, well tried, very good. We are very happy. We love when you interact with us. We want this to be a very interactive session. All right, so during the break, I was told that there's someone who wanted us to just go back to section A. I'm not sure if there's any specific area you wanted me to address, but the question or the response was that they wanted me to go back over section A. Not getting anything else, I'm just gonna quickly look from 7 to 11. And if there's any other person who you wanted a little more clarification at this section, then feel free to just quickly type in the chat so that our chat monitors are able to either bring it to my attention or to address it directly in the chat. All right. Feel free to hold up your hand also if it is that you want the question to be answered live at the end of the presentation. All right. Now, I had mentioned lines 7, item 7. Is this your first time filing? And I had said before that the system, because it is online, it already has the answer to that question. If you select no when it is yes, you will be prompted to say you have answered incorrectly. All right? So we want you to know that once you select yes, when it's no, you'll be prompted that, okay, review this question and re-answer. Line 8 or item 8, have you commenced trading? I mentioned before that this particular question is tied to the implication of the loss provision that is in place by law. I had used an example at that time to say, there's a school of thought that says persons who are in business may not become profitable for the first year, 2, or even 3 years. What we're asking and what we're saying here for this particular question, once you have answered the question, have you commenced trading? Yes. We're going to be looking at now how long you have been trading. There are 2 different criteria. Have you been trading within the last 6 years? That's one. Or, so there's another, or are you earning your gross income for that particular year was 10 million or less? Now, if in year 1 you made a loss, that would have been 23, for example. So 23, you made a loss. You're at 24 now, and the question is being asked, are you within your first 6 years? That already is a yes, because you are now at the second year of trading. So if this year, 2024, that you're filing for your IT02, you have now, made a profit. Whatever you made as a profit, remember, your chargeable income is what we tax you on. Then we look at other provisions like the credit. So if it is that you have now made a profit, the loss that you made, that is not for 2022, 23, you should, because the provision is that you must carry forward your loss. So it asks about loss from prior period or prior years. Then it asks if you have made a loss in this period, because we're looking at the total accumulated loss. So if you made a loss only in year 1 and year 2, you're profitable, the value of that loss, you're able to claim it against the profit that you now make in the second year. So that's what it is saying. So you have to make sure that you are answering the question accurately, because the system is going to look to see if it is that you have answered in a manner that allows you to benefit from this provision. If you're outside of that, meaning that you earn above the 10 million or you're outside of the 6 years, you are only allowed to write off 50% of your loss against your profit. So you're restricted to 50%. So the provisions are that within 6 years or under 10 million, you're able to write off the entire loss coming forward from prior years. So you have to understand, for reporting standard, you made a loss in a prior year. The loss is to be brought forward. You're not to just ignore it and don't report on it. That is not proper reporting. We have to account for losses, and the treatment of losses are guided by the provisions that are here. I do hope that is clearer. Then we look at line 9, where it states that you are to indicate which category you fall in. Now, a company is either regulated or unregulated, right? Now, the regulated companies are specific regulatory bodies. So we have like the Bank of Jamaica, they regulate. We have the Office of Utility Regulation, they regulate. We have the Financial Services Commission, they regulate. So these are regulating entities. They are taxed at a different rate. So in addition to being regulated, their rate of tax is different, and that rate is 33 1/3. Now, I have mentioned that over time, we have different revenue measures. So one of the most recent measures that came about is that we now have 2 other categories. All right, so we have the independent power producers. Independent power producers, these are companies who use 75% or up to 75% of their renewable sources. And we're talking wind and solar. These are renewable sources. So nothing outside of wind or solar, right? Not water. Wind and solar, you use those to generate your electricity for your business. So you would be allowed to still use a rate of 25% as opposed to 33 1/3. However, if you use 20% of your of wind and solar to generate electricity in your business, then you will have to file at a rate of 33 1/3. Then we have a 4th component, which is the trust and corporate services. These are entities that are set up to manage other companies or manage the asset of other companies. So they are allowed, by law, they are taxed at the rate of 25%. Box 11, we mentioned that as an organization, we have evolved and we're constantly changing the way we do business. We have a number of revenue measures. We have gone and incentivized a number of initiatives. And so what happened is that as we progress, there are some that existed then. Over time, they have been phased out, but we have some that exist now. What we're saying is that these incentive act covers these industry. And so they have a different arrangement. And I use the example that you may have a particular incentive act that allows you to be tax-free for 5 years, and then for the 6 to 10 years, you are taxed at a lower rate. So you have a little tax holiday in this particular incentive. We're saying if you choose to remain under this incentive and benefit from the provision that is there, you can't benefit from like an ETC, or you can't, and otherwise, you have to move or graduate from there, or that incentive that you fall under will have to phase out. Then you benefit from the existing incentives that are in this dispensation. So I do hope that you understand now. If there's anything else or anyone else have any question relating to this, then I am expecting that you just post the question in the chat or raise your hand so we can further elaborate. All right. Now, we want you to know also that we have another webinar that is scheduled for Friday. And for that particular webinar, we are going to be looking at, doing a demonstration of how it is that you actually register to file online. So for the purpose of this presentation, what we'll be looking at is pretty much the requirements for online filing. So if there's no other question relating to the form itself, the IT02, we're now going to be looking at our final phase of the presentation, which is the e-service. Now, I mentioned repeatedly that we have a mandatory e-filing requirement. Returns, income tax return, payroll returns, GCT returns, your returns must be filed online. Now, how can you file online unless you have an online account or online access? So we're saying that for you to file, you must be registered. So filing or applying to file is either you can do it inline or online. What do I mean? Let me backtrack a bit. All users of our system must have an e-service account, right? What I mean by this, all users, no exception. If it is that you don't have a business, but you have a motor vehicle, or you have your own property or even access to other properties, you can do payments online. So filing is a different component. So if all I want access for is to pay, no problem. But I must have an online account. I must register to get that access. So I can pay for a traffic ticket. I can pay for a fitness fee. I can pay my property taxes. And that's all I need to do. But I'm not filing because I don't have a business. That is okay. You don't need to further engage tax administration. So all users must have their online account enabled to make a payment. For you to be able to file a return, you must apply for the online service for access to the ability to file. So all I need to do is make payments. I don't need to engage TAJ. I just go on their website, and the website is there, www.jamaicatax, that's one word, .gov.jm. I go on, all it asks me for, my name, a valid a valid email address, and then there is, I need to provide a username. A username, it can be anything you want it to be. It can be letters only, it can be numbers only, or it can be a combination of both. But it must not exceed 12 characters, and it must not have any special characters. So I am good to go because I don't have a business, but I need to pay for my fitness fee and I need to pay my property tax. That is okay. I don't need to further engage tax administration. However, I have a company. I registered with Companies Office of Jamaica, right? I am registered or incorporated. So I need to be filing because by virtue of registration or incorporation, the law according to Section 71A states that as a body corporate, I must file. So I can't escape that. All right. So I am now liable. I need to apply to TAJ to be able to get this access to go on and to file. Now, how do I get this access? We're saying the general requirements is that there must be a valid government issue ID for the appointed account manager or authorized officer. Now, we only need one. So the account manager or authorized officer is one. Now, any further requirement depends on who is this authorized officer or account manager. Now, I am Barrett Limited and I am Disha Barrett. I also have another director and I have a secretary. Now, if I choose to be my own account manager, I need to produce only my government issued valid identification. In our system, we already have you registered as a responsible officer. So we know who you are. So when I produce my ID and the officer checks, whether inline or online, they will see that Disha Barrett is the registered director. So therefore, my ID is okay. Disha Barrett, the director, has decided that, okay, I need to hire the services of an accountant. So I'm appointing someone outside of the company. This person is not a responsible officer. They are not a director. I now need to provide the authority, TAJ, with a valid identification for that person and a supporting letter of authorization. It is to say that I am authorizing John Brown to be my account manager. The letter must be duly signed. The signatory must be one of the responsible officer, one of the director. We're expecting the signatory to be one of the responsible officer. There are times persons may apply online and they're rejected because what they have done probably ask their manager of the business to sign that letter. We will not accept it. We will reject the application, but we will notify you why it was rejected. So once it is that none of the responsible officers is named as the account manager or responsible officer or authorized officer, because we use the name interchangeably. So we might say account manager, authorized officer. It is the same thing. Once you are not a responsible officer, as per Company Office of Jamaica registration document that you provided when you, that we would have had to provide you with a TRN. So when the TRN was applied for, we'd have had all this information, who the responsible officers are. So I would look and I see that Disha Barrett was one of them. So I will know if this person only requires their ID only because they are already a director or a responsible officer, or am I appointing someone outside of my company? So I need proper authorization. The letter must be on the company's letterhead and we want to see the stamp. Those are a must. Must be on the company's letterhead and it must be stamped. Naming whoever your account manager is, and it must have the valid identification for that person. This holds true whether the person is coming in line with a manual application or if the person is applying online. And as I said before, on Friday, we are going to be looking at the individual income tax return, which you as a director may be liable for at that point. So we want you to also come back for that seminar. At that seminar, we're going to be doing more of a physical demonstration of the online process. So for the inline, this is you walking in with the manual application. Now, the application is on the same website that I just gave, www.jamaicatax, that's one word, .gov.jm. You go to forms, and once you go to forms, you go and look for the e-service application. You can pull that down, complete the sections. Sections A, Section B is no longer applicable because our online access allows you to finish up B. So A and C, very, very important. Sections A is all about who the applicant is. So it's the company. The company's name, the company's TRN, the company's address, and associated contact numbers. Section C, who is the account manager? Is it one of the directors? Is it someone external to the company? And so you're going to put the details of the individual or the account manager, authorized officer, as we name them. You're going to be placing their information at section C of the application. And remember, we have the area for you to stamp, and we have the area for you to sign and to state your capacity. So you have the name and the position, right, on the application form. So that takes care of the manual application. So you walk into the tax office. If you are Disha Barrett of Barrett Limited, my valid government issued ID, my completed application. Section A is about Barrett Limited. Section C is about Disha Barrett. And I have all of this together. I give it to the officer. But remember, before you go there, remember I mentioned about creating the account that all users must have. All users must create their account, register their account. So even if you're just making a payment, so section C, box 14, it asks you for the username that you create. And remember, I gave the parameters. It must not exceed 12 characters. It can be letters and numbers. It can be letters only, can be numbers only, no special characters. So you place that at box 14 of section C, and in a few minutes, subject to the code that is there, you are registered for the online services and you are ready to move ahead to your filing. All right. So we are now going to be looking at the online, and it's pretty much the same thing. Visit the website, you create the account, just like how I said to you. You go to www.jamaicatax.gov.jm. You register your account, basic information, your name, a valid email. And if the email is not correct, meaning you'll probably leave off the .com, it will prompt you that the email is not correct. And there's a text and a gender verification. After which you move further, there's a disclaimer. Use of any public platform, there is always going to be a disclaimer. You click that, there is a question and answer section. Now, the security question section is really for you. What it means is that if you're locked out of your account, you are able to use this feature to self-help yourself to get back into the account by providing the correct answer to this particular question that you would have answered. And it allows you also to create your own question and provide your own answer. So once you have done that, you are given access because you are now able to pay. What you now do on the same side, if you look at bullet 4, it says there's an area that says apply for an e-service account. You click on that, and once you click on that, the first page of any of these is usually information. It tells you about the service, what you need to do, and all of that. Once you have done that, you are able to follow the information, attach your ID, attach your authorization letter if it is needed, and you submit. Once you do that, within 2-3 days, most times as an authority, we try to process within the day, but we try not to let it exceed 3 days, and you are given immediate access. Remember, like use of any other platform, make sure that you store your login credentials properly. All right. So that's it for the e-service. And the final is just to wrap it up, all benefits of proper record keeping. You can't know about your capital allowance provision if you did not remember that you bought an item, or even if you remember you bought it, you don't have the receipt to show the value of the item. So you are not able to properly report, right? A proper reporting system, we expect you to have documents that shows date, description, and value. That is basically the feature of a proper record, for example, like a purchase receipt and so forth. We are saying business operators are required by law to maintain proper records in English to substantiate their income and expenses. So it's not an option. And it's definitely not going to help you in an audit situation. Remember, I said anyone in business is subjected to an audit, random audit, industry audit, anything. The focus is for the audit unit of that year. You could be selected. Record speaks for you. Business records are to be maintained for a minimum of 6 years. When a new year comes on, you can drop off the older year, right? But always, because you can be audited for 1 year, 2 years, 6 years. It all depends on the focus of the audit unit. 6 years. And what does good record keeping? What is the purpose of it? It monitors the progress of the business. There are those of us who have excellent memory, and we can tell when is a peak time, when business is good and whatever. Record ties you down to a dollar value of how good the business is doing, or the reverse. Identify sources of income. The record tells us this is investment, this is rental. We get the return, you declare it, but when you are in a situation where you're audited, we can say, okay, these are the rental income, these are investment, this is from trade, and so forth. It keeps tracks of deductible expenses. You don't want to miss any of it. Remember the deductible expenses, it reduces your chargeable income. And remember, chargeable income is what we tell you how much you're going to pay depending on the tax rate, whether 25% or 33 1/3, whether you're regulated or unregulated. It's very, 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 very important for the preparation of your financials. We can't emphasize that. You are placing information on your financial records, and when you're audited and you're asked to bring your financial statements and all of that, the records are there. One of the common one is probably the banking information, purchases made with a local and overseas. We need those records. It substantiates the items reported on the tax return. Remember, I mentioned that we try to capture all industries, but new ones have emerged. And so there are times when there may be a unique industry that you need to convince the officer that this was a necessary expenses that I had to incur in order to get this income. But how can you convince without showing the auditor the information in terms of a record? And finally, it shortens the processing time for an audit. The auditor is not comfortable coming to you every time. Ask for this record, you tell come tomorrow. They come back tomorrow, they say come. No. And you definitely don't want us coming into your business every day. You'd want to know that, okay, you ask for the record, I put them together, you come and we make them available. So it cuts down the time of the back and forth, and it shortens the time. So we wrap up, we close off, and we move to the next level, because guess what? These are my returns. I have declared this to be my income. Here are my records. These are my expenses. Here are my records. These are my capital purchases. And I did my capital allowance. Here are my records. And everybody is okay. All right. So that is it for me today. As I said, I do hope you have flooded the chats, because we want your feedback. It helps us to really prepare better and to address your needs specifically. So thank you for having me today. It is bye from me today. Have a good day. And I thank you for coming, for participating. I want to thank my supportive team. I know they're in the chat. Technical team. We have a resident specialist here. Very, very supportive. We're very, very happy to have you here. My entire team from my location is here. Thank you all. Thank you to the technical team. Everybody, thank you. Thank you for taking your time to be here. And we do hope you have learned something. God bless you all.
With this AI tool, you can create ready-to-sell beautiful kids coloring books from just a single keyword like these in minutes. Not just this, you can also